Hey guys, hope you're doing well. Let me get this going on Facebook here real quick. Okay, let's see. Page. Okay, let me get you promoted and we will get started. All right, got some of the new folks. Joe, good to see you. Holly, always good to see you too. Kay, good to see you on. Kevin, Laura, Liz, Michael McGran, good call the other day. Looking forward to the next one. Oh, Josh, good to see you. Rob Perot, always good to see you, buddy. Let me just make sure I'm doing this correctly. Okay. I think I've got everybody so far, and there'll likely be more. So let's see if Jim's on. Let me check my phone. We got Jim Martin's going to be on tonight, talking about the lending business. So let me see here. Let me check panelists real quick. See if Jim's on the panelist block. Sam, good to see you. Lisa, good to see you. Kendra, good to see you. Okay, let me text Jim real quick. Oops. Jim Martin. Tonight. Okay. Okay, I just spoke to Jim the other day. I interviewed him on our podcast. Everything should be okay, but you never know. Things come up. Go back here real quick. Yep. Let's see. Oh, Kathy, there you are, Kathy. Bunny, good to see you. Okay. I'll give Jim another minute. We've got plenty of content to go over if he needs to reschedule. But so while we're waiting, actually, let me type in a big hello first. I should have done that in the beginning. Monday. Okay. Hey, show of hands or a chat box if you want to. Anybody watching the Olympics? I always watch them. I love the Olympics. Yeah. So I'll tell you a little bit of a interesting factoid. I was at the 1980 Winter Olympics, and that was the year the Americans beat the Russians. That wasn't the gold medal round. The gold medal round is when we beat the Finns for the gold medal. So we obviously won the gold medal that year in hockey. And the big thing was us beating the Russians. And does anybody remember that? I know I'm probably dating myself here, but so what was cool, Kay, is my stepdad ended up being called up to be on one of the organizing committees. We were literally the night the Olympics were starting, we got a phone call at home from his headquarters up in Detroit, and he worked for FTD, was an accountant, or really like a regional. He would do the accounting on all the FTD, the flower stores. They call him up, and somebody couldn't make it. Who was supposed to be there couldn't make it. And they said, Bruce, can you go? And this was like 10 o'clock at night, guys. Like literally the day before everything starts, all that the athletics during the open ceremonies. And my stepdad didn't flinch. He grabbed the phone and said, look, everybody, start packing your bags. We're going to the Olympics. We're leaving in 1 hour. So we drove all night to get to Lake Placid. And we had our own little trailer to stay in because he was on one of the committees. We got to stay in our own place. We got to eat whatever we wanted. We got to go to any event we wanted to. And we were able to drive our car. We got a special pass to drive our car. We didn't have to fight with the buses and everything. It was amazing. I mean,
that's awesome.
Yep. And this was 1980. And in 1980, guys, the country was really in a funk. We had gone through the Vietnam War, the gas crisis, the Carter years, the Iranian hostage crisis. We still had our hostages over there. And we really needed a lift. And that was the beginning of a great decade. I mean, it was amazing. I actually got Mike Ruzioni, the captain. I got his hockey stick. Yep. I got Jimmy Craig's goalie stick. He was a goalie. And I got to go in the locker room. I was grabbing like socks and shirts and pads. And it was just like a free for all. And then and check this out, Melanie. If you look at the replays of the closing ceremonies, my sister and I are on the ice, handing to the athletes as they came out on the ice. Yep.
That's awesome.
Yep.
That's so cool.
That was, I mean, so to this day, probably one of the greatest experiences of my life. And I'm planning on, in 24, the Summer Olympics are in Paris, and in 28, they're back in LA again. So I'd like to go to the Paris ones. The LA ones, I mean, I've been to LA lots of times, and I would like to go to Paris to see those Summer Olympics. And I could have been gone to both Summer and Winter Olympics, but what an 17 years old. I was 17. It's amazing.
Awesome.
That's fantastic.
Yep.
My husband would be so jealous, Gary. He's a huge hockey fan. We totally remember when that happened. And we thought our biggest win was getting Bobby Orr's, one of Bobby Orr's famous shots before he left the team. And here you are with Michael Ruzioni sick.
Yeah.
That's awesome.
That was crazy. Yep. So in any case, that's hard to believe that was 42 years ago, but what a time. We got to meet so many people from around the world. And if you think about 1980, as far as like, any type of wars, nobody was really shooting anybody at that time. It was, there wasn't a lot of security. We were meeting, princesses and queens and kings, and wherever an athlete was, people would just congregate around them, and we would get autographs. And I don't know if they still do this at the Olympics, but you trade pins and things like that. So we were trading pins, and I got to meet Chuck Mangione. He's the guy, the trumpet player. Met Dorothy Hamill. Can't remember all the other people, but it was just it was really awesome. So, thanks so much, stepdad. Yep.
That's cool.
Thankfully, my natural father would have said, well, well, we don't know. It's a long drive, and we haven't made plans for this. My stepdad was like, pack your bags, get in the car, we're going.
That's awesome.
Yeah. Yep. So let me, I saw, Jim, I see that you're on. Let me get everybody promoted here.
I'm very, very sorry. I was on a customer call and I couldn't get off. So I tried to get off as soon as I could.
I was entertaining the troops. So.
Doing very well with it too.
Yeah. So, hey guys, Jim, I'm going to promote you to co-host.
Okay.
So guys, I want to introduce you to a really good friend of mine going way back, Jim Martin. We worked together for years in Pittsburgh. He was on the lending side, I was on the broker side, and we got to know each other. It's just a super guy. His son was Eagle Scout, my son's an Eagle Scout. He knew my background in banking. So we hit it off well. And we actually, our claim to fame is we were literally getting ready to launch our own, I don't know if you necessarily call it a bank, Jim, but our own lending company, our own mortgage company, be it as mortgage brokers. And we had just had an event. This was in a group area called Green Tree. And we were there at the table with another gentleman, Louis, kind of finalizing things like what we're going to do. And it was literally one of those 11th hour things that it was when the recession had already started, we're sort of at the bottom and Congress is changing all the rules. And I just had this weird feeling. I said, I think we should wait. And we never did launch it, but in hindsight, it probably was a good move that we did wait, because when the rules came out, I already owned a title company and an appraisal company. And of course, I had brokerage and property management. And as you know, they changed the rules dramatically when it came to how our appraisals were done and how lending was done. So I just, probably would not have been good. I probably would not have been able to have both entities at the same time. And maybe I could, I don't know. But the bottom line is Jim knows his stuff, and he can lend commercially in all 50 states. And I think, Jim, you're able to residentially in 7 states. Is that right?
New York, Pennsylvania, Ohio, West Virginia, Virginia, and Florida, 6.
Okay, 6. All right. So maybe 7 is on the way. Maybe just put the Irish hex on it. You'll get number 7 here coming up soon. So.
Texas would be great.
There you go. Oh yeah, Texas. Any of the growth state. Yeah, Kay's from Texas. She'll go for that. So what I want to do, guys, is because it's our class, it's sort of a closed community here. And Jim, we do have agents from multiple brokerage firms. Okay. Most agents here are on the global investor agent team with me at EXP, but we have agents, KW, Berkshire Hathaway, Remax, different companies at different times. And everybody here, if you'd like to, I'm sure Jim will be open to you communicating with him and reaching out to him if you have borrowing needs, particularly on the investor side. Because remember, commercial doesn't necessarily mean, 50-story buildings. Any non-owner occupied property, like a duplex, if you're not living there and you're renting it out both sides, Jim, is that correct? Would qualify as a commercial. You get a commercial mortgage for that?
Well, let me clarify.
Okay.
When you're 5 units and up, when you're 5 units and up, it's always commercial. All right. Mm-hmm. When you're bundling and what we call blanket loans, when you're doing, multiple properties, maybe they're all single families, but let's say you have 4 single families and you're putting them all under one loan. That's a commercial deal. When you have a 1 to 4 unit, it could go either way. They can go both residential and commercial, depending on how you structure the deal. In our interpretation of residential commercial, if you take it in the name of an entity, that has to go commercial. You can't go residential with that unless the entity is a living trust. If you do it in your personal name or in the name of a living trust, then it's a residential loan. And for the agents out here who are not comfortable in dealing with residential versus commercial, my first recommendation is that you take a real estate attorney out to lunch and tell them, okay, what is the advantage of taking title in an entity's name? And what is the advantage of taking title in a personal name on investment property? And you'll go to more school in that 45 minutes for lunch than you've done in 12 years of public education. So there is a lot to be said about how you take title. And what I tell my clients when they call up and they say, can you do a 4 unit or a 3 unit or a single family investor? One of the very, very first questions I ask is, how are you taking title? And if they don't know, they say, well, I was going to just take it in my personal name. The next question I ask is, have you talked to your attorney about this? And if they say no, I'm going to be very insistent that they call and talk to someone, a professional, about determining their liability and their risk. Because after I tell them to do that, when they come back, like 95% of them come back and tell me, oh, I need to set up an entity. Because there is a lot of advantages if you are building up a real estate network to taking things in an entity's name. Now, if you've got 2 cents to rub together, big deal. Take it in your personal name. But if you are building a net worth for yourself or for your clients, and that is something worth protecting, insurance alone can't do it. It'll do a pretty good job, but it's not going to do it completely. And you've got to make sure that your personal assets are protected. Now, just because you create an entity doesn't mean, okay, I'm good, I can walk away, I don't have to worry about that. You have to treat the entity as the corporation or the empire, or the partnership or whatever it is that it is. If you do not maintain it, and by maintaining it, I mean separate bank accounts, annual meetings, and filing separate terms, and running the business expenses through a business account, then you might as well not even bother. So it's not be all end all. Some people just don't have that characteristic where they can pay attention to that sort of thing, and okay, we'll adjust to that. But for the majority of people, it provides a compelling reason to take out the name and the entity. And the other thing is, I have a lot of people who say, well, I'll just take it out my personal name, and then after I build a bunch, build my empire, I'll just transfer them all into the name of the entity. I'm like, well, you could do that, but here in the city of Pittsburgh, where I'm located, they have a 5% transfer tax.
Yeah.
And if you're moving it from yourself to your own entity, you're paying all of it. And that to me seems like wasted money. So you might as well get it right the first time when you're buying these properties, and you just put them in the name of whatever, however you want to take it, but do it first right at the get-go. And then people say, well, I don't have the entity created, it doesn't have 3 years taxes. How can I get a commercial loan? You can get a commercial loan with an entity to be created. So there's, just be careful when you're writing your contracts and you're talking to your investment clients, especially if they're first-time investors. And I really encourage them to get involved in that. But I equally encourage all of you to at least sit down with a real estate attorney. Maybe it's your settlement agent that you refer business to, and just talk to them and say, look, I seem to be getting more real estate investors, and my finance guy is saying I should really ask my clients how they want to finance these, whether it's in an entity or a personal name, and should I do commercial loans or residentials? Because residential, they have advantages. There really are. I mean, they're 30-year fixed rate loans, and they've got low rates, and it's sometimes 20% down, 25 or 30, depending how many units it is. But that's compelling. But at the same point, if you lose all your assets because someone slips on your sidewalk and sues you, and there are people out there that are looking into the names of title holders, and if they see a rental property, it's not unlikely that they could set you up. I mean, it's not unheard of. The story I was telling Gary earlier is I had a client that called me up. He wanted to buy another investment property, and I asked him, how are you taking title? He says, oh, for sure, I'm taking it in the entity. And I said, okay, you seem pretty sure about that. He goes, yeah, I had another property that I lost because I had it in my personal name, and I was at the airport ready to go on vacation. And right before I got on the plane, the desk agent told me to pick up the courtesy phone, and there was the Brentwood police, the borough in which my property was located, telling me I had to come back to the apartment or the building that I own because there was an incident. It gets back there, the ambulances, fire trucks, and police cars, and all that stuff all around. And apparently, there was a dog that had broken through the door in his rental house and attacked this guy and ate his dog, and severely hurt him. And so obviously he was getting sued. Well, he came back during the court and he said, well, wait a second. My lease says no dogs, and the tenant who lives there does not have dogs. Well, it turns out the tenant had a boyfriend who was watching the apartment while she was gone for the weekend, and he brought his dog, even though the tenant said, don't bring the dog, you're not allowed. Well, he brought him anyway, and the dog jumped through the door and attacked him. Well, guess what? Landlord was the only one with money. And the lawyer's going through everybody. They're going to, they obviously put a judgment on the guy with the dog and put a judgment on the guy, on the lady who was a tenant. But then they also went after him because he's the one that had all the money. And then some people say, well, I'll just get an umbrella policy. And for most people that can work. but it's got limits, whether it's 2 million, 3 million, whatever it is. And then the other thing is, if you have a claim, try to get the policy again. It may not be so easy to get a second policy. It's kind of like having cancer and trying to get another health insurance policy or life insurance policy after having cancer. So, there's obviously concerns. But on the flip side, I do a lot of commercial business. And on the commercial side, typically what I see is there are much, much fewer headaches than what you see on a residential investment property. Residential, they cap you to 10 finance units. Once you own more than 10 finance units, they won't take any more. And that presents a problem when you start buying more and more property. And then they also say that for every unit you have, you either need 2 or 6 months of liquid reserves in verified funds. So if you have 10 properties and each property has a $2,000 payment, 6 times 2, that's 2,400. Well, I mean, 1,200. So that's $1,200 in verified funds at the minimum for each unit. Now you're talking about $12,000 in liquid funds that you need that aren't going to be used in the transaction, but it could be as much as 6 months, depending on what your credit score is and so forth. So now all of a sudden you got to verify a lot more cash than you did before. Plus the underwriting, you go to a loan officer and you show them that you have 10 properties, their face is just going to melt because they don't want to go through and put all those loans in the system and all those properties in the system and then have underwriting go through. It's a slow, tedious process because each and every one of them has to be accounted for. On a commercial loan, they're like, yeah, bring it in. They look at the project, the property itself, more than they do the guarantor. In a residential loan, it's about 80% of the person and 20% of the property. On a commercial loan, it's exactly flipped. It's most of the attention is based on the property, how much income it generates, what the expenses are. And then they look at the guarantor and say, yeah, just in case the property doesn't work, we'll go back to them. Do they have good credit? Yep. Do they have solid income? Yep. Does the income cover their personal debt? Yep. Okay, we're moving on. So I've found the underwriting on a commercial loan to be much, much quicker and smoother than it is on a residential loan when you're dealing with people who have multiple properties.
Yeah. I know for me, guys, I started off doing traditional residential type loans, mainly FHA underwritten loans. And they were great, 30-year more amortizations, low, the interest rates were low. But what I realized is as far as the equity buildup, I wasn't gaining much ground. The cash flow was great. So when you have a longer term, generally your payments are lower, so you have greater cash flow. But eventually I did switch to commercial, and it really wasn't necessarily because of the 10 limit rule, or the 10 property limit rule. It was really because I started recognizing a lot of the people I was learning from and people I was starting to hang around and become friends with who were far more advanced than I was, were all doing commercial loans. And so I eventually switched. And, years later, as I'm selling, as you might guess, the ones that I bought later on, but had commercial loans on with 15-year terms, I had far more equity than the ones I bought even years earlier, but had a 30-year terms on them. So your 30-year mortgage, it's usually around year 20 or 22, I think it is, when you hit the halfway point, principal, right, and interest. But on a commercial loan, you're looking at, somewhere between years 7 and 8, and you're halfway done. So what happens is, let's say you don't have to sell, or you don't want to sell, all that equity becomes leverageable. Okay. So then you can start to grow your portfolio more rapidly by having all that equity that you can access. All right. And, people will say, well, wait a minute, Gary, no commercial lender is going to take a second position. And that's what they'll say on the surface. But I'm telling you, I've done it. I got a big commercial blanket mortgage across 10 of my properties once, just on the equity. And it was a commercial mortgage, and it was a line of credit. And that was really my turning point in my business. So I went out and bought a big building, and it just kind of went up from there. And I'm sure, Jim, you remember Enterprise Bank?
Oh, yeah.
That was the one that was started by real estate investors, and they were tough. Those guys were, boy, you don't want to cross them.
Yeah.
And they were real. I remember them telling me this was like a 90 unit building I was buying. There were 78 units. I'm sorry, 78 units. And we talked about it. I said, why is this so much easier? And the president, you ever meet Chuck, Jim? I can't remember his
I
last name.
did. Yes.
He
Yes.
looked at me and said, 'Cause we don't care about you. We care about the property. That's what he told me. And he said, you could get by the bus tomorrow if that property is going to stand on its own. And it's just a real eye opener for me. He didn't mean it in a harmful way. It was just being
That's funny.
matter of fact. Yeah.
Yeah.
But I will tell you guys, when you're working with your investors, most investors will start small, duplexes, single families, things like that. I would say it's okay. Let them do the traditional residential mortgages with a 30-year term because they'll have more cash flow. And as they grow, just work with them, grow with them. And most investors will eventually evolve and go into the commercial arena. It's easier, it's faster. I mean, guys, most of my properties, I never went into the bank. I just called them up and it said, okay, we got it. No problem. We'll see you when it's time to close. And a handshake and a signature, and it's all done. Residential, boy, it's just like a big ritual. You got to go to the closing, 4 or 5 people sit around a closing table. It's really not necessary. I mean, most of my investors, including me, we never even went to closings. It's all done electronically,
Not only that.
Yeah, go ahead, Jim. Sorry.
On a residential loan, you are literally recreating a file every time you do a new loan or a new purchase. You're starting from day one. Now, you might have some of the same documents, but it's a different underwriter. It's a different loan program. I mean, it's probably the same loan program, but it's a different underwriter, different processor, you could be the same loan officer, but it is definitely starting over again. So that whole package is being recreated. Now, sometimes they can keep some of the docs from previously, but most of the time you're recreating everything. On a commercial loan, give me the details about the property, let me review it, and then you're closing as soon as the appraisal comes back. So, but the thing that a lot of real estate investors don't realize, at least initially, the new ones, is that property becomes a tool. And Gary hinted to it. Mm-hmm. There's a complete disconnect in new investors in the way most of them look at property. A lot of them are coming to the process as if they were buying that house to live in it. And they make that mistake in many, many ways. First of all, a lot of them will buy property that they'd want to live in. And that's not the way you want to buy property. You buy property in the areas where your tenants want to live. And then they fix them up to the point where they'd want to live in them. And that's not the case either. You obviously want to upkeep them and you want to make sure that they're good property, but you're going to put the money in that's most effective, but not too much. I mean, you're not going to put hardwood floors in because people kill them, but you'll do laminate flooring instead of carpeting because it's a lot easier and you're not always replacing carpeting. But I have other guys who say, well, I just buy the little tile carpets and I pull out the bad one and glue a new one in. But you're doing things that you probably wouldn't do in your primary residence. But the other thing is the property is a tool. And as that equity builds, having that equity sit there is lost opportunity. So if you can take the equity out of that property and use it to buy another one, then you are in this process of adding to the income that you're making. And if it works for one, it'll work for two. So if you make $200 on one property, you can make $400 on two, and $600 on three, and $800 on four, and so forth and so on. So the more you rinse, wash, and repeat, the more frequently you can cash checks. But a lot of people don't have the equity necessary to do that or the cash to do that. But as the equity builds, especially in these markets where we're seeing 15 and 20% rate of returns, and in some places, I don't know if any of you are out there in Vegas or Phoenix where you're looking at 25 and 30% rate of returns, that equity is building very quickly. And now it's an opportunity to take that equity and make it work for the next property. So a lot of my investors really don't care what the terms on their mortgage is, as long as the numbers still work. And if it's a 5-year fixed rate loan, which is how most lenders do it, they do like a 20-year amortization or a 25-year amortization, and then they have the rates reset over usually a 5 or 7-year period. You get the best rates with a 5-year reset. But the investors really don't care, because in the end of 5 years, they're probably going to refinance, take the equity out, and do it over again. Because every 5 years, you want to look at that asset and make sure you're evaluating and make sure it's still doing what it's supposed to do. Are you able to get the tenants in that you anticipated? Are they paying the way you anticipated? Are the expenses being where you had forecasted them? And they're definitely reviewing that on a definitely an annual basis, but after 5 years, they're either going to fish or cut bait. So being locked into a 30-year rate, that's great, especially in the market that we were just in, where you're talking about a 3 and a 4% interest rate on investment property. That's fantastic. But going forward, when you're seeing nothing but increasing rates, in 5 years from now, who knows what the rates will be? But the rents will be sky high too in 5 years. So I have investors that chase me down for rate, which is fine, and we do get them the most competitive rate they are. But it's a false premise, because if the numbers work at 3.5, they'll probably work at 5% when the rate resets, because rents will be up that high, especially in this inflationary market that we have. Now, obviously, it'd be nice to make $300 instead of $200, but at the same point, if you're taking that cash out and able to generate $400 instead, it makes sense. And that's where a lot of our investors are going. They're just every 5 years taking the equity back out and moving into the next one. And you can point to Gary and say, Gary got a second mortgage. Well, Enterprise Bank is literally the unicorn. There aren't a whole lot of lenders that are doing second loan positions. They're out there, but you got to search long and hard. And Gary, I don't know if that was done prior to 2015, but since 2015, they really start tightening us up.
Yeah, that was way back. Oh my gosh, that was probably 1999, something like that.
Yeah, the second mortgages now are really, really tough. The examiners have really come down hard on them.
Well, what's interesting, when I first started out investing, I thought it was far more conservative. I thought I'd have to keep saving up down payments to keep buying new properties. I didn't realize that it was expected of me from the lenders for me to leverage what I already had, leverage against that equity to buy more properties. I didn't realize that till later on. Now, in hindsight, it probably was a good thing, because when the recession hit, I was pretty solid. I had, a lot of properties, a lot of equity, in a solid position there. And it served me well during the recession. But really, I probably would have grown a lot further, a lot faster had I leveraged earlier on. Now, having said that, I just want to tell you guys, I am pretty conservative, and I'll give you some ratios just so you can share this with your clients. So when I first started out, just like a lot of investors, I was leveraged to 80%. Now, I had banks tell me, no, you can just 10% is all we need in the year. But I thought, boy, that's really pushing it. So I was 80%. But the ratio I was looking to manage was this. So two ratios, same genre. One ratio was the what I owed versus what I owned. And I never wanted to owe more than 2/3 of what I owned. So if I owned 10 million in real estate assets, I didn't want to owe more than 6.667 million. Okay. Then on the income expense side, it's the opposite. On the income expense side, I didn't want my principal and interest payments, not taxes and insurance, just principal and interest, pure debt, to be more than 1/3 of my gross receipts. And I learned when I managed those two ratios, and Jim, you can vouch for this, I never had any problem getting loans, So
could you repeat that, please?
Yes.
The ratios, I love that.
So on the asset liability side,
Okay.
once I got through my first year, I tried really hard to get to basically 2/3 equity position. So I didn't want to, 1/3 equity position. I didn't want to owe more than 2/3 of what I owned. So if I owned 10 million, I wanted to owe not more than 2/3 of that. Okay. So if you look at somebody's financial statement, you got a balance sheet, you got asset liabilities, then you got income statement, which is income and expense. On the income expense side, I follow the banking rule, which is principal and interest should not be more than 1/3 of your gross receipts. Now, eventually I got to 50% equity. And at that point, I was really able to kind of write my own meal ticket. I never wavered from that. I mean, it took a while to get there, but once I did, I wasn't calling the bankers; they were calling me.
That's exactly right. You're very, very strong at that point.
Yep. So, hey, Jim, can we talk a little bit about, in different times, like if you look at, say, the early 2000s, I mean, it was like the wild, wild west. People were borrowing money left and right. Banks had these loans like 125% equity loan, you know, and we, of course, what happened, but when times get tough, during the last recession, of course, the capital markets tightened up and they were far more strict. And I think as an industry, we maintained some of that strictness enough to make sure we were sound again. But now here we are again. Looks like we're on the cusp of another correction. What can our agents look for? What are some of the signs or indicators that the capital markets are starting to tighten up a little bit? Like things they'll say or products to offer, indications that they're starting to, be more cautious than they were, say, 3 years ago.
In 2006 and 7, I was strictly on the residential side and had been doing it for a number of years. And I've been through, 3 cycles prior to that point. So when things started getting noisy, so to speak, I was like, okay, here we go again. No biggie, another time to readjust. Because normally the markets adjust about every 10 years. So we were anticipating this. In early 2007, the company I worked for had another division that was called non-prime. And this was back in the day when you could do clients with 500 credit scores with 100% financing, and all you had to do was smile and get a loan. So that non-prime company started sending out emails in the beginning of January and indicating that they were cutting back on certain aspects of products. We're like, oh, that's weird. So like, if you had a 500 credit score, you could no longer get 100% financing. Or if you had a 550 credit score, you couldn't do just bank statements. You had to back it up with something else, pay stub or something. And throughout the early part of 2007, those kept coming back. And then about April, we got a notification that the non-prime company was shutting down. All right. I'm like, okay. Now, back then, there was a thing called the implodometer. And you can still go to the website, www.implodometer.com, and see a list of all the subprime lenders that went out of business and when they went out of business. And it's it's a living history of what was happening then. In August of 2007, actually late July, we started getting notification on our side, and we were doing conforming loans. These are Fannie Freddie, just vanilla type, no risk products. And we started getting notification that certain aspects of our programs are being shut off. And we're like, ooh, this is hitting close to home. Well, that quote unquote shit hit the fan very quickly. On Monday, we lost a couple programs. By Friday, we were closed. So, yeah, and I was on vacation. So that was an interesting trick.
Yeah.
When you start to see that there's programs out there called non-prime or non-QM. QM stands for qualified mortgages. And qualified mortgages are those with full documentation. They're Fannie Freddie government loans, FHA, VA, USDA, whatever. And they meet certain requirements. So as long as they meet these requirements, debt to income ratio, documentation, credit scores, that sort of thing, the government gives the originator of that loan a pass that they automatically meet qualified mortgage standards. Well, there's some lenders out there that say, hey, well, there's still a buck to be made by offering products that don't have this guarantee, so we'll offer them. So they're bank statement loans, no debt ratio loans, no income statement loans. The old stated product thing is kind of back, especially with investment properties. So if you start seeing those start dripping out and falling off, and the lenders that offer them start closing down, that's when your rear end might get a little tighter and you're getting uncomfortable and your back needs a scratch. And that's my experience. You'll start seeing consolidation within the mortgage industry, because what happens is a lot of lenders are originating loans and immediately selling them off in the secondary market. And as long as there's a market for these products, they'll continue to do that. Well, what happens is in a time of contraction, those secondary investors start running to what they call running to quality. So they'll just buy the Fannie Mae's and Freddie Mac loans, the FHA's, USDA's, and VA's, the one that come with the government guarantee. And these other products, they won't buy them. So all the lenders that did them need something to do. And what they'll do is they'll merge with companies that do nothing but Fannie and Freddie. So you'll start seeing a whole bunch of mortgage companies start, merging together. They'll bring their sales staffs together, their operations and marketing and reputation and so forth. And that might last, but usually what happens is they both collapse because the weight of the non-QM is going to strangle everybody. They're legacy loans that are just going to be really, really difficult to overcome because they have to set loss provisions aside, and the company that takes them on has to assume those loss provisions. And the federal government just makes it more and more difficult to do that, and they'll just declare bankruptcy. So as an agent, if you have a client that wants to buy a property under a bank statement loan or a non-QM loan of some sort, I'd be really, really careful, especially in this era of really tight inventory with many, many buyers lined up. I mean, if I had one at a non-QM that was offering me 20% more than the list price and another one that was regular straight Fannie Freddie conventional loan or a jumbo loan that was at 15% over list price, I'd certainly take the one that wasn't non-QM. I really would. Knowing the inside of the market and how it takes to get a non-QM loan closed, ugh. And we are seeing increasing interest rates, which is also having an impact on the lending industry. Last year, there were some mortgage companies that were originating, 50, 60, 70, 85% of their portfolio of their origination was refinances. And they completely forgot about the purchases. They may not even know how to do a purchase because the whole basis of that company is built around a call center that's calling people saying, hey, send me your mortgage statement, I'll get you refinanced. And you send them a purchase contract, they have no idea what they're doing. And now they've got to shift gears because that's where the business is. And as they're going through this, they're learning and they're fumbling. And they, instead of taking 30 days to close, they're taking 90 days to close if they close at all. Now there is an advantage to doing maybe one of those. If you got a client who's really, really tight on cash and you got an investor or lender who doesn't know how to quote transfer tax, and they quote it wrong, they got to eat the difference. It's awesome. And the buyer ends up getting their transfer tax paid by the lender a lot of times. So anyhow, that's aside. So in your question, how will you know? Look at the mortgage industry and see who's going out and what products are leaving with them. That's your canary in the gold in the coal mine, so to speak.
Yeah. Well, I remember in 2007, it was the way it played out. It was August when the stock market started doing that teetering it does when it's at the top, which is exactly what happened in January here. And then, through September through November, of course, it tumbled. And I think, Jim, 1/3 of the mortgage brokers had just left the business. They were just gone. 1/3 of them. I mean, in 3 months, it was fast, Yep. Yeah. Yep.
I'm sorry, just to emphasize that point. In 2006, I was the vice president of the Pennsylvania Association of Mortgage Brokers. We had 7,000 members in 2006. By the end of 2007, we had 700. 90%. Yep.
Yeah. Well, what's funny is I had done a flip and I closed literally on July 30th. And I remember I had that big check. It was like, at that time it was big, $75,000. I'm thinking, I think I'm going to sit on this one. And I just had a hunch. Sure enough, the stock market started doing this crazy thing. And I would tell people, I don't know if you should be flipping right now. I don't know, and sure enough, man, it crashed. And I was down at Frank McKinney's place in October, and people in Florida, he's at Delray Beach, people in Florida were coming up to me asking advice. What can they do? Because they bought all these pre-build, pre-construction condos.
Yep.
And when the capital markets dried up, the builders had no more money to build. They just, all you had was a piece of dirt with a white pipe sticking up. And some of the people did have fully built townhomes and stuff. And I said, well, you either rent them out and tough it out, or you walk away, or you just somehow or another, you just hang on to it. I said, there really is there's no magic formula. This is considered a kind of a catastrophic thing in the world of economics and banking. And we hadn't seen anything like it since the Great Depression. It was that big. And I don't know if you guys knew this, but at the time, 30% of our mortgages were underwater in the country. 30% were underwater. And I don't know what the number is now, but right before the forbearance was lifted back in the fall, FHA did say publicly 30% of the mortgages were underwater. Again, John, a lot of people probably got back in the game of paying their mortgages when the forbearance ended. I don't know if Jim, you have any least statistics on that. It seems like everything's stabilized now, although inflation's going up, interest rates going up. So we know we've got a correction coming. That's a fact. But as far as the health of the lending of the loans, I don't think it's what it was back in 2007. It doesn't seem like it. So
no, it's not. It's in a normal market, you got about one, maybe 1.5% of the properties that are more than 90 days delinquent going into foreclosure. Right now, we're about 5%. So it's a little bit higher than normal, but nothing crazy like it was back then. I remember getting phone calls from clients, and they'd call me up and they said, Jim, you did my mortgage last year. I want to turn it in. I said, okay, why is that? And he goes, well, we're the last house on the street that's still occupied. And this is a house of 100 houses. This is over in Vegas.
wow.
Like, well, yep, that's what it is.
Yep. So
yeah.
So let's do this, guys. You got Jim here, and I would, if you could, type in questions you have. But Jim, one question I'll lead with is, none of us have a crystal ball. We can't tell when there's going to be a correction. We just know that there is. I mean, it's just part of being in a free market economy. You're going to have your ups and downs, and we've been on the upside for quite a long time, guys. And whenever you have those fundamental characteristics of inflation going up and interest rates going up, it's going to have a cooling off effect on most markets, including real estate. The wild card here is, we need more housing. But again, you got to temper that with the fact that it costs more to build a house now. Wood, everything, labor, everything costs more. Now the money's going to cost more. So Jim, what is agents and investors, some of us are investors too, what can we do to look good to a lender? Because I know when the economy does turn, guys, man, it is Christmas time. If you're understand economics and you're an investor and the economy turns, as long as you're prepared, you can make a lot of money as an agent and an investor, or both, like me. I'm telling you, that brokerage company I had, guys, believe me, it wasn't because I was some kind of a Harvard graduate genius. I just happened to have the right model at the right time. It really is the truth. We already worked with investors with all those relationships, and it was just like an avalanche of transactions. But on the borrowing side, Jim, what can our agents tell their clients as far as how to prepare for what, in all probability is probably coming down the road here, and also be able to still borrow, when that happens?
I hate to sound like a broken record, and you probably heard this before, or a skipping CD, or whatever it is now. But cash is always king. I hate to say it, but lenders throughout time have looked at the borrower's balance sheet, and the more liquid funds that they have to absorb the shocks of the market, whether they be ups or down, the stronger position they will be. And if that means you don't buy as much of a house as you normally would, that's probably an opportunity. If it means putting 5% down instead of 20% down, it's hard for me to make blanket statements because a lot of clients need a lot of personalized care. For my clients that are long-term, and they're buying property and they're going to stay in the property for 5-7 years, they got a long-term window, I don't worry about down payment, because even if the market crashes and it goes down 15%, they'll have plenty of time to recoup it. But if it crashes 15% and they can't put food on their table, or they can't make the mortgage payment because they've been laid off for 6 months because they put all the money in their house, then I'd much rather they have the cash so that they have a reserve fund with which to make that mortgage payment. Because you just don't know what their job situation or their income situation is going to be like. If they're short termers, that's a tough one. If you're only in the housing market for 2 to 3 years and you can't absorb the downturn in the market, I don't know if you should be in the market to be the first place. I don't know if you should invest. I think you should save your cash if you can. But cash truly is king. And the more cash you have, the better you're going to be able to weather these storms. But more importantly, if there is no storm, let's say you got a perfect job, or you're self-employed and you've got the mousetrap worked out, and you know exactly where the mice are going to come, and you're going to take advantage of it, and you're going to make a ton of money. If you have cash, then you could take advantage of a lot of real estate investments opportunities that others can't. While other people are running to the door, you're running to the front of the room to pick up all these properties that everybody's selling. And you're going to be able to get them on 10 cents on the dollar, because there will be foreclosures. There will be tax sales. There will be sheriff sales. And if you've got cash, you can pick them up. But as far as a lender is concerned, keep your debts to a minimum. I can't tell you, I see people that are buying cars every 2 years. Like, oh, geez. I mean, you might as well just throw your money away. They're buying brand new cars at $700, $800, $900 a month in car payments. And every 2 years, the dealer's calling them up. Hey, it's time to get a new one. The XY 2000 just came in and you got to buy it. Now, if the price of electric cars comes down and the infrastructure is there and the range is there, there will be operating efficiencies to buy an electric car that are far superior to a gas car. Okay, I can see upgrading to that. But outside of that, it really doesn't make a whole lot of economic sense to be buying a new car every 2 years. Honestly, the last time I bought a new car was, when was it? 2001. There are so many, well, this market's messed up, and maybe you can't buy a used car, but in the normal world, you can get a pretty decent used car for a 20% discount over what a brand new car is. But yeah, keep your debts to a minimum. As far as charge cards and credit cards, the ideal is to keep the utilization under 10%, but definitely keep it under 30% utilization of the credit lines. If you can do that for 6 months, you're going to get a huge boost to your credit score, because the credit is also really, really critical.
Oh, yeah.
The difference in payment or rate for a client with a 700 score versus somebody with a 740 right now is a quarter point, and that adds up. If you're below 700, you're the first one on the chopping block. The 620s are going to find it really difficult to get a loan. 620 to 660s are going to have a pretty difficult time in a downturn. You're going to have one option, that's FHA, unless you're a veteran. And maybe at 680 you'll have an option, but you're definitely going to pay the price. And the mortgage insurance is going to be extremely expensive for that too. So the best thing that your clients can do is just keep on working on their credit. And the easiest way to do it is to get that credit utilization under 30%. Do that for 6 months, and that's good for at least 20 points, probably 40 points for most people. And then the other thing is diversify your credit. If you've got one credit card from like a nationwide provider, Discover, Capital One, whatever, diversify. Get a store card like a Kohl's or a Home Depot or something like that. Don't carry balance on a Home Depot.
Yeah.
Use it, but don't carry balance. But get a diversity of credit cards. Maybe, and I have people that are having trouble getting their credit started, and you can get credit started with a secured credit card. And essentially what that means is you walk into a bank with a $300 cash, they set that aside, they open up a CD for you, and that CD will build interest, but at the same time, they'll give you a $300 credit card. You start building up your credit utilization with that, and you show that you can manage credit properly. And after about 6 months, maybe 12 months at the most, they'll release that CD and become an unsecured credit card. And that's a great way for a young person to get their credit started. But you want to have a diversity, not just a credit card, but a diversity of credit cards, like a store card, a local bank, national, just mix it up a little bit. And
Yeah. One of the things, Jim, I always encourage, this is one of the things I teach in our scripting too, for everybody. You haven't heard this before. These are 3 questions I ask every prospective client. When I attract someone with the marketing and I'm interviewing them, they don't know it's an interview. I'm basically having a conversation with them. Once I've built rapport, we've established they want to buy something. I always ask them, I need to find out some information from you in order to move forward. This is information you're going to need eventually anyways from a lender, but also whoever's selling a property, that agent, their client's going to want to know that I've screened you. So first question is, what do you have in savings? And I wouldn't ask them, hey, how much money you have? I would say, what do you have in savings? It's a softer approach to get the same answer. I want to see if they have cash. That's number 1. Number 2 is I would ask them, do you have an available line of credit? Remember, guys, Jim said, keep utilization to under 30% of lines of credit. So if we knew they had an available line of credit, that means some bank somewhere thought enough of them to give them a line of credit, which is generally a second mortgage, and it has available funds on it. And then the third question was, by the way, do you know what your credit score is? I wouldn't ask, what is your credit score? I would ask, do you know what it is? Because ultimately they would tell me. If they did, they would say, yeah, it's 738 or whatever. So then I knew I had what I needed to work with them without wasting my time. Now, what if they had 2 of the 3? What if they had a good credit score and cash, but no line of credit? I'd work with that person. Or what if they had good credit score and a line of credit with availability on it, but no cash? I'd probably still work with that person too. But the point is you want to ask those questions up front. So because your time is valuable. Your time is your most valuable asset. You want to work with people that can actually get the loan. And there was something else I was thinking of, Jim, when you were talking. I just lost my train of thought. I'm trying to remember what the heck it was, but in any case, I'll probably remember like when I'm going to bed tonight. But it was I learned a lot from being in banking on the banking end of things. But I also learned a lot from banking by being a consumer. Oh, here's what I was going to suggest. So when I was really in the market, aggressively growing, I know I said earlier, I try to manage to a 2/3, 1/3 ratio on the asset liability side. When you're aggressively growing a portfolio, it's expected that you're going to be more highly leveraged. To me, 80% is about as much as I want to go. And the reason is if you live long enough, you're going to have some type of crisis. Someone's going to pass away. You're going to lose a job. You're going to get divorced. You're going to, if you're highly leveraged and you get in a car accident, that may seem like one isolated event, but if you're too highly leveraged and you need to be an agent to earn commissions to supplement your family's needs, you could be in a world of hurt. That's why you want to keep your leverage in check. It's not what happens in good times that matters. It's what happens when a crisis happens. And I'm going to wrap this up with one final statement about banking. And I learned this from an elderly gentleman. I don't even know if he's still alive. You ever meet a guy named Larry Newman, Jim?
Yeah.
American Financial. Yep. So he told me, look, when I met him at an association meeting. All you guys join associations, just participate, engage, meet people. And we were talking about lending, and I was like picking his brain because this guy was dialed in. He was sharp. And he did a private lending and commercial lending. And he said, here's the deal. Lenders, anybody who has great scores and cash and all that anybody can borrow money in a good up market. He said, what bankers really look for down the road, when you build a portfolio, like Jim said earlier, they don't care so much about you, the person, they care more about the properties and all that. He said, if you can show them that you can get the ship to shore in the middle of a storm, without jumping overboard, in other words, without going into bankruptcy or foreclosure, you'll never have a problem getting loans. I used to be a banker, and what's funny, Jim was talking about buying used cars. We are so much alike. I haven't bought a new car. I can't even remember the last time. I only buy used cars. Now I get nice used cars, but I let somebody else take the depreciation and I get them for half price with most of the life left in them. But in any case, back to this. Your clients and you maybe yourself are going to have some type of crisis at some point in your life, and it's going to affect your credit more than likely. the challenge is can you keep things afloat in times of crisis? If you can, I promise you, bankers recognize that, and that means almost as much to them is what happens in good times. How do you behave in bad times? Jim, any final thoughts on that? Like, it's going to happen. It's a matter of yeah.
I will also say one other thing, Gary. You're absolutely 100% correct. But I'll add to that, and this is for you personally and for your clients, especially your commercial clients. Don't put all your eggs in one basket, because Bank A may not weather the storm as well as Bank B. And Bank A may be taking decisions to protect themselves that are going to have a greater impact on you or your clients than Bank B. So you can help yourself by establishing relationships in good times with, I would say, 2 banks, no more than 3. Get to know your banker. I mean, that means your branch manager or your loan officer or your banker, the one who is reviewing your information and making those decisions. And if that's a big bank, great. If you find a big bank that's able to help you and service you and get your products, fantastic. Just be careful of your fees, because big banks tend to charge more fees. But I have found great success working with the medium community banks and the credit unions. And I would diversify. I'd say, okay, I got myself a little local commercial bank, and I got a really strong, solid community bank, and I got myself a nice little credit union I do a little bit of business with. The more relationships you have, and I would keep it to 3 at most. But if you have some good, solid relationships, if one starts peeling away and they don't like investment real estate, more than likely one of the 2 will still keep it because they like it. And if you put all your eggs in that one basket that they don't like investment real estate, or for whatever reason they're becoming extremely removed, then you've tripled your chances that you don't have to change your way of life dramatically. But don't just get to know the teller, get to know the people who are the decision makers and the people who are going to fight for you, and be good friends with them. Take them out to lunch and just really get to know how they operate and what they're looking for, and how you can improve your standing with them. Because each bank's a little bit different. There's a lot of generalities between all banks and credit unions, but each one has its own little special taste. So that would be if I were to leave this meeting with one takeaway, that would be it. Work with somebody. And, as a broker, I do that every week. I meet out with all my lender relationships and just keep them going. Meet a lender.
When I first got started, guys, and this is something I learned from Jim, is when you're looking to borrow money, especially if you're just starting a new endeavor like investing, and this is for your clients too, obviously, is think of your lender as a partner, business partner. And I learned to approach him. I would call Jim and ask him, hey, Jim, what do you think the best way is for me to approach this deal? And I value your judgment. How can I best structure this? You approach it that way with lenders, then you got a friend for life, and they will work to help you make that deal work. They want to make the deal work, So, but a couple more things before we go. We got a guy named Lou Carlson on. Lou, I'll get to you in just a second. And Jim, he's bringing up information on what's called an open-end mortgage. But before I go there, as I just want you to know, we've been talking about conventional, traditional financing tonight, because that's Jim's background, my background. I've done private borrowing and lending too, private money, hard money, the whole 9 yards, owner financing, did all that stuff. And Jim's not opposed to it either. In fact, Jim will tell you, in some cases in consultations, he'll tell people, I think you should do private money right now, So I want you to keep that in mind. Jim's not just one dimensional. But Jim, Lou Carlson's on from New Jersey, and there's a new product coming out called an open-end mortgage. And I haven't heard about it until Lou brought it up a few weeks ago. But have you heard of this? Where they actually, Lou, go ahead and unmute yourself if you wouldn't mind. I know you talked about this the other week, but is this a commercial bank you heard this from, or tell us about this product and how it came about?
Well, an open-ended is a real safety net. Actually, people shouldn't refi their mortgages. They should just go ahead and replace them with an open-ended loan. First lien position, open-ended loan. And it's basically simple interest. There's not it's not amortized. Where the banks are really robbing you blind. There's so many advantages to this new product. It's not new. It's been in other parts of the world, but it's starting to gain traction now.
So if I understand it correctly, you have a mortgage and it's almost like a reverse mortgage, except it's not a reverse. It's a structured.
No, you just have access to your money.
Yeah, you're
You
basically
have to
using
have a
your-
minimum of 20% equity. You do have to have a high credit score to get it.
Yep. So essentially you're using it, you have a mortgage on, you have a note that you've given a lender. So you need a mortgage to tie the note to the property. So you're borrowing from a third party, I'm assuming a bank. You're borrowing against the value of your home, but as far as the payback, in other words, you're not on a structured payment schedule.
No, you're making payments just like a mortgage.
Okay,
The only thing is, it's not, the interest is not front end loaded.
because it's simple interest.
Well, yeah, it's simple interest. So more is going towards principal, actually.
Okay,
So Lou, I have a couple questions for you on the, because essentially what you're dealing with is a HELOC as a first lien
Yeah,
position.
it has the same characteristics as a HELOC.
Yeah, HELOC is an abbreviation for home equity line of credit. So
Right,
essentially what you're dealing with is a line of credit that's open-ended, which you're absolutely right. It's simple interest. If the rate is 3%, you take your balance times 3% divided by 12, and that's your minimum payment.
right.
Anything over that goes right to principal.
Right.
There are a couple things that I'll point out, and each client can weigh the value or the concern with each. On a home equity line of credit, as you said, the bank, the way most home equity line of credit agreements are written, there is no definitive end, but the bank can shut it off at any time. In
Well,
2008,
yeah, that's not the case with this.
okay,
Of course,
good.
what you're saying is true with the HELOC.
Yep.
This is just like a 30-year. There's no time period where it basically closes on you.
Okay,
You have access to your money for 30 years.
that's fantastic.
Yeah,
Yeah.
yeah.
Then the other question I have is,
It's a true blessing. It's going to revolutionize the mortgage industry.
is it a fixed rate loan though?
It is fixed.
Oh, then that answers the other concern I'd have. Now,
Yeah.
More than likely, you're not going to be able to add your escrows in, so you have to pay your taxes and your insurance on your own.
Yeah, which is an advantage.
Yeah.
Yeah, that gives you more cash flow each and every month.
Right.
hey
Go
Lou,
ahead,
did you
Terry.
hear about this from any particular bank, or was it on like a podcast or?
I heard it from my dad back in 1960.
Okay. But I mean, in current
My-
times, you've heard the subject brought up in recent times too?
Oh, yeah, there's a group, I'm actually with a group that is promoting this.
Mhm.
Yeah.
Okay. I mean, is there any company you can think of, a name like a PNC Bank, Wells Fargo that offers the product?
Well, no, there is a company, I'll share that with you, Gary, and you can share it with the group at
Yeah.
another time, okay?
Okay. Yeah. If it's through Lou Brown, that's okay. These guys all know Lou, Lou.
No, it's not. In fact, sometime this week, I'll be introducing it to Lou.
Gotcha. Okay.
Yeah,
Okay. Yeah, because I know for some people, like there's people here, Lou and Jim, from all different markets. I mean, East Coast, West Coast, Maine, Hawaii, even. And so Naomi, for example, Hawaii, I can see something like this really being popular because you're in a market where you've had obviously a lot of rapid price increases, right? And it's a great place to flip. By the way, people, if you have anybody who wants to flip, I mean, talk to Naomi in Hawaii. I mean, you guys can partner with her and do some co-brokerages with her on this. She'll be feet on the ground, and she's already helped other flippers out there. But a product like this, I think, could help homeowners and investors alike, particularly in a place like Hawaii, you know? So,
Mhm.
yep. Any case, guys, I know we covered a lot of ground tonight, but I just wanted to give you, a good contact in Jim and let you see that he's a real person just like you, and has a lot of experience. And when I personally endorse him because he's a personal friend of mine, and we've done business together over the years, and just solid as an oak tree. Just good salty there, good character, and he will absolutely tell you like it is. I mean, how many of you have had clients go to lenders promising, oh, this is going to be easy, only to have it fall apart at the end because underwriting didn't approve it? Anybody ever had that happen to them? Yeah, that's not a lot of fun. And we just had one happen the other week with one of our agents out in Monterey Bay. So in any case, if you have questions, I don't mind staying on a little bit. Jim, if you got an extra minute, sometimes we get questions at the end where people have personal situations.
Yep, that's fine.
Yeah. Has anybody got a client they're dealing with now, or a loan situation, either yours or a client's, that you want to get some advice on? You guys are quiet. That's maybe it's already time for ice. I got a brand new packed line of ice cream too, so I'm excited.
Gary, I have a question.
Hey, yes, sir.
It was recommended to me to get a home equity line to have on the side, so when investments and things come up, you'd be ready to put that money down. Is there? I know there's some that are better than others, the HELOCs. Any recommendations on the banks, or that they're doing a better interest rate for high credit?
But each location is going to have their own special product or special lender out there who's going to be super aggressive. I have a lender here in my market that's a 15-year draw, 90% loan to value, and it's $150 one-time fee for their home equity line of credits. So the important things to look at is the draw period. How long can you take money? How long can you use the line? The non-aggressive ones are 5 years. The normal ones are 10 years. The aggressive ones are 10 plus. 15 years is really aggressive. The second thing to look at is obviously after the draw period, what's the repay period? So let's say you use the line over and over and over again. Now you've got a $200,000 balance on your line. Well, coming up with $200,000 to pay it off is not going to be so easy. This particular lender gives you 10 years to repay the $200,000. So what's the repay period after the draw period? So if you happen to have a balance. And then what a lot of lenders will do is they'll just refinance the HELOC into the next one if you want to go that route. But then what's the maximum loan to value that they'll go? Now so they calculate that, they take the appraised value of the house, multiply that usually by 90%. If you're aggressive, a lot of them are in the 80s, some are in the 70s, but the aggressive lenders are at 90. They'll take 90% of that appraised value, subtract whatever first mortgage you have or any other liens against the property, and that's the amount of line that they'll give you. So the amount of the line is really important. The cost obviously associated with it. Now, some lenders will say there's no cost as long as you keep the loan or the line for 3 years or more. And if you pay off the line in 3 years or less, you'll have to repay all of our costs, which could be anywhere from $300 to $1,500, depending on what like recording fees are and appraisals and that sort of thing. Mm-hmm. So you want to know about that. And then also, what is the annual carry fee? Is there a maintenance fee that they charge every year? It should be like $100 or less. So those are some of the things I would look at. Credit unions tend to have aggressive programs, but they're not always as aggressive as what some other lenders have in each community. Does that help, Joe?
Yes, thank you.
Okay. By the way, Michael McGrant, I just typed the answer in the chat box. Michael was asking about the name of that mortgage that Lou was talking about. It's called an open-end mortgage, Mike. Lou's going to be joining the team too, so we'll have him on board here next couple of months. Hey guys, I did think of one more thing. This actually goes back to the beginning of class. I was talking about the Winter Olympics in 1980, and something I wanted to mention that you just can't see in the newsreels when the Americans beat the Russians in that hockey game. I was behind Jimmy Craig's goal cage during the first and third period, so I stayed down there, after the game was over, and they had the American hockey players on the ice with the flag around them. And what you can't see is in the stands, people were crying. I mean, it was just an amazing, totally unexpected, never in the history of America, people would imagine that a bunch of college kids, remember back then, the U.S. Olympic athletes were all amateurs. There were no professional athletes, hockey, basketball, none of them. And so these college athletes beat Russian professional hockey players who played in the United States, by the way, when they were playing for money. But if you could just imagine what that was like, people just in the stands crying, just American flags everywhere. It was an amazing time for our country. And I just wanted to put that because I didn't mention that earlier. And it was an amazing experience. And hopefully, if you ever get to watch the movie A Miracle on Ice, it's a pretty good depiction of what really happened. They have some actual scenes in there, some real footage. And the guy that was the coach of the American team, Craig Patrick, became the general manager of the Pittsburgh Penguins for years. So, any case, that's my nostalgia for today. Hey, look at that, Naomi. Who's that?
Oh, you're on mute.
Silas,
Silas.
you're muted. There you go. Hey, Silas.
Oh my goodness.
So we're pet lovers on this team. We got people come over there, cats and dogs and babies and all kinds of stuff. So
He's my 90-pound 1-year-old German Shepherd.
Nice. Yeah. So, well, guys, I tell you what, it sounds like that's probably about it. Hopefully did everybody get their questions answered? Jim, can people get a hold of you? How can they get a hold of you if they have questions?
I'm just about to put that in this chat box.
Okay.
So I have a website, jim@srtfinancial.com, or my phone number, I'll put it in here, 412-418-1536.
Okay.
Yep.
Okay. So next week, guys, remember this, there's no class next week. It's Valentine's Day, so I'll be with my mom. And we'll see you on the 21st and the 21st. Liz, I think Liz is Liz is still here. Liz, that's the day you're teaching, right? Oh, this is going to be perfect. So on the 21st, Liz is going to teach us about setting up an entity, like a simple LLC, for example. And how timely is that right after Jim talked about mortgages? Remember, the first question Jim asked is, how are you going to title this? Oh, by the way, I do have one piece of advice. I've had a lot of investors tell me, you know what? Don't worry, I'll set up a different LLC. I'll get that all changed before we go to closing. Your lender has already gone to bat for you, right? With one entity name. You know what I'm talking about, Jim? Yep.
Oh yeah.
You go and pull that switch on them. When you're at the finish line, it's gonna cause a problem. So just remember, know your entity before you start the process, you or your client, and explain to them why you can't just change things on a lender like that, or the title company, by the way. If a title company pulls title, right, and you go and change it, they're gonna charge you more money. That title policy is for one entity. If you change the name, they're gonna have to pull the title again. So, I don't see Jim's contact information. Please, can someone share? Okay, hang on one second. Let me get that.
Yeah, I don't see it either.
Yeah.
I don't
Can I
find
just
it.
say
Gary?
one?
Gary, this is Mark. It didn't show up in the comment section.
Yeah. Hey, Jim, go into not the Q and A, but the chat
I
box.
saw what I did. Yeah.
For
yeah.
everyone. For everyone to see.
Yep. My apologies.
Except Melanie. Don't let Melanie see it. We can't have Melanie see it. No, just kidding.
He sent it to me first.
There you go. Yeah. So, hey, Kay, also, Melanie's in your area. She's KW, but she's in your area. So, she's I've known her for a couple of years, taught her at a marketing center, and she's excellent student. So Kay's new to the GIA team, Melanie, and she's got a great, we got a great client we're working with out there. Oh, did you get what you needed from Sean Ritchie, Kay? The property description? Yes. Okay, good. We'll save that little surprise for everybody. Oh, you're muted, Kay. It's right here. Yeah.
Hey, Gary,
Yes.
I have to run if that's okay. Are you guys all good?
Yeah.
Gotta
Hey,
go.
Jim, thanks again for doing this.
You're very
Yeah,
welcome.
I appreciate it.
Best wishes.
I'll let you know when I'm back
Thank
in the
you.
Berg, and we'll go to lunch. Okay.
Perfect.
Thank
Sounds
you.
good.
Thank
You're very
you.
welcome.
We'll get
Good luck
together,
to you.
Melanie.
Yeah, sounds good.
Thanks.
Guys, take
Bye.
care of yourselves. Take care
Okay.
of your pets and take care of your family. God bless you and your families, and we'll see you in 2 weeks.
Okay. Thank you.
Bye, everyone.
Bye, thank you, Gary.
Thanks. Bye.